afternoon, everyone, and welcome to a BFM webinar. Today, we're taking a look at should I cut my protection plans or insurance plans during bad times? And I think this is a question that's come up on a lot of people's minds, especially those who are facing cash flow problems. And this is obviously as the MCO and the pandemic have hit people across the board in different proportions, but definitely we are feeling those impacts. Now, this webinar is brought to you in conjunction with the Financial Planning Association of Malaysia, who have helped us bring all these experts together to over the last few weeks to help you out with these issues. And let me introduce my guest today. Oh, but first of all, my name is Roshan. I'm the producer and presenter for Ringgit and Sense for BFM 89.9. Co-moderating this discussion with me, Malek Ali, founder of filife, also founder of BFM Radio. And our two experts today, we have Fateen Rosli of Vantage Advisory. Hi, Fateen. And Kevin Neoh, BKA Wealth Planners of BKA Wealth Planners. To the both of you, welcome back to the webinar.
Hi, thank you for having us.
Thank you for having us.
It is completely our pleasure. In fact, thank you for taking the time to speak to us. Always a pleasure to have you on with us. Now, before we get into the big questions that we're all trying to answer today, how have the two of you been doing? Kevin, if I remember correctly, you just had a kid.
Yes, indeed. Happily enjoy my time with the baby.
That's good. And Fateen, how are you? How's the family?
I was thinking of today might be the last MCO, but yeah, another 1 month to go. Today was supposed to be the last day.
Yeah. And Malek, how about you? How are you keeping?
I'm good, thank you, Roshan. Fantastic. Looking forward to this webinar.
Oh, always looking forward to talk to you and everyone else here. So the premise of this today's conversation, of course, is talking about insurance. So we've talked about cash flow, we've talked about retirement, we've talked about estate planning as well last week, which brings up this whole question of protecting your family during a difficult time, and how do you optimize for cash flow, I guess. So let's start with the basics. Some people out there may not have any protection products or insurance products. So Kevin, can we start with just why do we need protection products?
Why do we need protection product? It's just like, why do we need to bring an umbrella when we go out from our home? Because sometimes unexpected things may happen and we need something to protect ourselves. In that example that I've just mentioned, we are protecting from ourselves from getting wet or soaked by the rain. So in life, we all have goals and aspiration. So for example, you want your kids to study in overseas, and then you want to be healthy all the time. But unfortunately, this is not everything that we can control. So sometimes we may get sick. For example, it's very relevant to time like this. We may just get sick because of a virus, and you need to have money to pay for quality medical attention and treatment and whatnot. So having a protection product allows us to have a peace of mind, knowing that if this kind of thing were to happen, it's okay. If I will have to fall out, I already have a safety net or cushion to absorb the impact so that it can minimize my injury. So I think it is important to have protection for everyone.
So essentially, protection products or insurance is insurance against something's bad happening to you. And I think that really comes down to what product or what coverage you're getting. And that can get all very specific. So let's talk about the types of coverage out there, the types of protection out there. Fateen, could you help us with this? What kinds of products are there out there?
Okay, like Kevin mentioned, there's protection against your life. There's common. And then there's also on your income replacement, also on your health, hospitalization, medical. There's also general insurance against your assets. That is the general insurance protection. So for life, why is it? What's the purpose? It's for your family to continue in times of premature death of the breadwinner in this sense. For income replacement, that is when, like Kevin mentioned, when you're sick, you cannot provide to the family. So there's protection against total permanent disability. There's also protection when you have like critical illness, like stroke, heart attack, those kind of event happening. So there's also another one, which is also equally important, which is the hospitalization. When you're sick, you need to seek treatment. So there is the policy, which is hospitalization and surgical treatment. Pre-hospitalization, there's also post-hospitalization coverage that is offered by the insurance company. The fifth one, like I said, there's a general insurance, protection against your assets in case of like fire insurance for your house. Also, there's car insurance if there is damage, if you met with accident to your car. Yeah. So that is some bit of examples of insurance available.
Each of it basically catering to a particular, protecting a particular asset or particular event, right? So it's very specific. So life insurance against a premature death, income replacement in case anything should happen to you to stop you from generating income. So these are all various different products out there, and it can get confusing. But I think as we discussed on Friday on the webinar, it really comes down to something, the life cycle, right? Where you are in your particular life cycle. So Kevin, could we get into that? What kind of products should you be getting at different stages of your life? Because it can vary, like all the way from a student all the way to retirement. These are all different types of life cycles there.
So first and foremost, because before we sign off on any insurance application, you will always notice a very bold font that reads as a warning that buying an insurance is a very personal and a long-term decision. That is why it is important for us to realize one thing, that each of us has a very unique situation, and even though our age may be similar, but we may be in a very different life stage. For example, a person who is in the late 30s can be married or can be single. So you have to know where are you standing in terms of life cycle. So I will talk about student. Fateen, you want to cover what would student needs?
Okay, sure. So for parents, what can you buy for your kids? So example, they're not working, they're a student. So you can protect them by providing hospitalization or surgical policy. So that's what it's important policy to have for a student. So if you're starting, just start working, so you might want to analyze, do you have like the employee benefits given to you? Is the coverage enough, the employment benefits? If you have like a surplus on your cash flow, you might want to get your own policy, so that it doesn't matter if you want to change your job, those kind of things, you are already protecting yourself with your own policy. So, okay, then the third one, the third life stage, which is if you get married. So once you get married, you need to know whether are you the sole breadwinner or do you have co-breadwinner. So why is this important? It's because of if you starting a family and there's people depending on you, in this case, your spouse. So you might want to, if your spouse is like contributing some of expenses with you, so you might want to get insurance to get the sufficient coverage, just in case like I said just now, the premature death happened, or because you need to get income replacement, because so that one is really important. So other than just the medical or hospitalization benefits policy.
Right, so each of them, again, different things you're going through, different aspects you need to take care of. So the other life stages include married with children, right? That's another one, big one. And Kevin, you've, as we discussed earlier, you've just become a parent. So enlighten us about this a little bit. What do you need to pay attention to in this life cycle of yours? What can you do as a parent?
So when someone has just becomes a parent, that means the one fact is that you added more dependent to your life. So you need to think about what happened to them when you no longer able to go home, or your ability to bring money back or put food on the table has disappeared overnight. So this is very important. So if you ask me, if a person is married with children, it is very vital that this person should consider review the life insurance coverage. This is very important. And it's not just covering about a premature death. Total permanent disability and critical illness is equally important as well. So on the dependent, your children, they do not need a lot of different kind of products. What they need is actually mainly maybe medical benefit, hospitalization. That will be the very basic one. You do not need to have life insurance for your child, because the child depends on the parents, not the other way around. But unfortunately, this is something that is being taken in reverse by a lot of parents. Then maybe another life stage will be when your children are no longer dependent on you. They have finished their studies, started working, and then the parents, maybe husband and wife, are now living alone in their house. So in that case, you still need to have, maybe not so much, but you still need to have adequate coverage in terms of your life coverage, because we may still die prematurely, and then our spouse who may have survived us, he or she will need to carry on his or her life on himself or herself. So you need to think about how to take care and provide for this surviving spouse as well. Then not to mention the last phase, maybe it will be retirement, or I have retired. So you will need a heavier reliance on medical insurance, because at this stage of our life, if you used to have employer covering your medical and hospital bill, after you have retired, this benefit may actually retire along with you. So you need to bear in mind at that age, you have to get some hospitalization coverage. It may be expensive, so it makes sense sometimes for us to plan in advance, just like our retirement planning. Cannot wait until that last minute only you start to plan. It will no longer be planning but panic.
I like that. No longer planning, but panic. It's something you said earlier that I want to just highlight there. Life insurance for children. This is it does commonly happen. And the important thing to know about life insurance is essentially protection in case anything happens to you, right? As if you are the breadwinner, you want to provide your family basically some compensation should anything happen, some protection to buffer them for a little while. Why so? And this is not something you should be looking at for children, right?
It's not the priority. Well, it makes sense for us to assume that sometimes children may be total and permanently disabled as well at a young age, or they may also be diagnosed with critical illness. But I've seen a lot of parents, what they did is they do not have a sufficient life insurance coverage for themselves, but they bet every dollar they have on their children, which is actually, I would say, it's the ballet already. You need, but not so much. Yeah.
Yes, Fateen, please.
Yeah, may I add? This happened to myself. This is my own case before I became a financial planner. So what happened was I paid a huge sum of insurance just for my son, also for myself and my husband. So we're thinking like, okay, we need to get an insurance. So we're being like introduced to the agent, this kind of things. And then surprisingly, when I engage a financial planner, so the person really go through all my insurance policies. Then the question said, she asked me, do you need a lot of money when your son passed away? This is something like, why? I asked. So she said that the coverage is about 100,000 plus if he were to pass away. And then this morning, I just like, but I surrendered the policy. But I just went back to the policy this morning just to have a comfort to myself. So the coverage is 130,000 for death and total permanent disability. But then the maturity is 20 when my son reached 25 years old. But how is it like education plan when it's like 25 years old, he's already finished university? I mean, like this kind of sometimes it's not just that parents wanted it to be that way. It's just like we thought we are providing for the son, but then we are
the other way around.
Yeah, the other way around. So like you said just now, supposedly the parents have sufficient coverage. So I look back at my old policy. There's only like 190,000. Then I calculated back 190,000. Can my family survive with 190,000 if my untimely death? Yeah. So I'm lucky that I reviewed it when I'm still a young parent, when I was like only 30, 31. Just imagine if like 20 years down the road, then only like I need to use that money or I need to make a claim. So it might not be sufficient for our family. So yeah, something to ponder.
So that's very important to note, right? And also just that that point you've highlighted, it's the amount of coverage you have. Like if you've got 190,000, as you've said, coverage there, that's if anything happens to you, that's the amount of money that your family will get, right? So it's about making sure that it's proportional to the risk of and the amount of money you need if anything should happen in case a said event happens, right?
Yes.
So we've actually got a question from Facebook. I just from Al Chan. Is COVID-19 covered under critical illness? And if yes, how many times payable to a bereaved family member? I think this comes under, people are a bit concerned about this at this point. Kevin, do you have any thoughts here?
Thank you for the question, Al. Just want to point out that COVID-19 is not considered a critical illness. If you want to know what are defined as critical illness, what consumer needs to do is to pull out their insurance policy or takaful certificate, go through the definition of critical illness. COVID-19 is a very deadly, unfortunate condition that a person can get infected. However, it is not a critical illness. So if you want to claim under critical illness, I'm afraid it will not work for you. However, if a person is diagnosed with COVID-19 and it subsequently causes death, then yes, if you can claim under death benefit.
All right, and just moving over a little bit now, just a quick recap before we move on to investment-linked policies. This afternoon, we're speaking to Kevin Neoh of VK Wealth Planners and Fateen Rosli of Wealth Vantage Advisory on the different, on whether to cut your insurance protection plans during a time of crisis or when you are feeling a bit of cash flow crunch there. Now, just in the last 15 minutes, last quarter, we've covered the basics of protection products, what kind of protection products are there, and basically the life cycle there. So as you go through life, you need different products for different things. And that's the most important, one of the most important things you need to look at. Right now, we're going into investment-linked products. So this is a very popular thing in Malaysia, and where a life protection is packaged with investments. So Kevin, could we just get into how do investment-linked policies work?
Well, investment-linked policy, as the name suggests, is your insurance product that is linked to the performance of the underlying investment funds in the policy. To appreciate how it works, you have to understand before the investment-linked policy was introduced in our country, when we want to buy insurance, all we can buy was only what we call a traditional whole life policy. So in that kind of product, you have a certainty of knowing how much of money you will expect to receive at the future dates, let's say 20, 30 years later, or when it matures. So that one places the risk on delivering the cash maturity benefit on the shoulder of insurance company. While with the introduction of investment-linked policy, consumer has to bear the risk of getting back how much of in the future. It completely depends on the performance of the investment-linked funds that you have selected. So investment-linked policy works in such a way that it is very similar to how the old insurance product works. You pay them a premium, they will provide you a benefit. But in terms of insurance-linked policy, it comes with only a basic benefit, which is a death and total permanent disability, whichever comes first. So if you need to have more benefit, for example, hospitalization, critical illness, it will be available as an add-on rider. So you need to tick the boxes, then only they provide you with those benefits. So the money we pay to the insurance company, say every month, it is called a premium. So when they receive a premium from the life assured or policy owner, this money will be invested into the funds that you have selected, or you instructed them to invest for you. Then for all the benefits they provide to you, there will be a cost of insurance. That means a price tag to it. So where do they charge for that? They will deduct the units of the funds that you have invested to pay for all the costs. So this is typically how an investment-linked policy would work.
So that sounds, it sounds very performance-based, I think. So could we just get into, just very, quickly, just follow up with that. What are the advantages or the disadvantages of a structure like this, Kevin? It's because it seems very popular in Malaysia.
In terms of advantages against disadvantages, I would say that the main very prominent advantages would be that it is flexible in a sense that it allows you to increase decrease or add on new benefits as the time goes on. And then you can also select what kind of investment funds you want the insurance company to help you to invest on those balance in the policy, as opposed to in the past where you only have traditional policy, you have no say. All the money they collected from you will be invested based on the mandate the insurance company have, and usually it will be very conservative. But having said that, although it allows you to invest and select based on your risk appetite, it does not mean that this is a very good product if you want to grow your wealth. At the end of the day, it is still insurance product and it is best suited for protection.
So that's a very big factor, right? So there's the separation between growth and protection. These are two essential part to any financial plan. But the investment link seems to merge or kind of be in the middle of the two, or at least try to position itself that way. I see you smiling there, Kevin. What are your comments to that? The growth versus protection argument there. Do you have any thoughts on that? Sorry, Kevin, did you hear me?
No, Roshan, you're asking me, right? Or
yes,
Malek?
yeah. No, I'm asking you, Kevin. Yeah. Sorry about that.
Okay, like I said, it's at the end of the day, you need to know that one thing is investment-linked policy is still an insurance product. It is only best suited for protection. No doubt, the funds inside still can grow your money, but it will be growing, your money will be growing under additional costs. For example, the commission you pay to the insurance agent, the marketing fee, the fund management fee. And because every investment-linked policy comes with a basic benefit of death and total permanent disability, it also means that there will be a minimum cost attached to it. So if you are choosing this to invest your money as opposed to other instruments, for example, unit trust fund, you will have additional cost in terms of cost of insurance. So if we want to grow our money, why not just go to the channel whereby the instrument that you can grow it at a minimal cost? So that's in my take.
Okay, so on that note, I just want to talk about comparing these kind of things with term life policy, because some people say buy term and invest the rest, especially since we're talking about growth, a little bit about growth here. I think we get your thoughts on that, comparing this to term life policies.
Yeah. Okay. Term life. It's the cheapest option that you can get that protects your life as well as on disability. So yeah, when you say about like buy term, invest the rest, it's because you will be able to maximize on the coverage with a lower price premium cost to pay to the insurance company. This is because, like I said just now, to my own example. So like you wanted to have like more coverage. You want to pay 30 cents for every 1 ringgit of your coverage. You don't want to pay 1 ringgit for only 30 cents of coverage. You see, because this is where you want to free up some of your cash flow so that you can invest or put it in other life priorities. Like example, like I discussed with Sam and yourself and Malek during our session before. It's like needs versus wants. So this is where you need to really look at on your coverage. If it's that you pay more but your coverage is insufficient, do you think it's okay? So you need to really look at, because if that your concern now is on the life, so you need to have every dollar worth of your premium pay.
All right. So then, Kevin, let's talk about how term compares with other options. Say, example, whole life policies. What are your thoughts there?
The only difference between these two, the very major difference, is that whole life policy usually it comes with cash value in the future. That means if you have paid for 20 years and you no longer needs the coverage when you want to terminate it, it should be very safe for you to expect to gather some money back. But as for term life, usually you do not have anything back. It just works like our car insurance. No matter how many years you have paid for it, the moment you stop, That's it. The coverage stop and the relationship just terminate. No money back for you. So this will be the major difference. The second difference is that because whole life policy has a promise of providing you certainty in terms of cash value or surrender value in the future, that is why it also needs you to pay a little bit more. Not a little bit more, it can be easily 2 to 3 times more.
Yeah.
For the same amount of coverage.
Yeah. Can I add on the term life? So the analogy of term life is like when you pay for your security guard for safety. So you might not see the benefits now, but they are doing the job in protecting you. So in case of break-in happen, you know you have that peace of mind. You are sufficiently covered. So it's the same with term life. So you might think that people will say that, hey, you pay for nothing. At the end of the day, you don't have any cash value. But do you know that every single cents that you save, comparing to the other products out there, you can put it in the one that cost efficient investment rather than putting it. Yeah. So it goes back to your discipline also. Yeah.
I guess that goes with the saying, right? The only time to buy insurance is before something happens, not after it happens. You cut. It's the only thing.
When you're still healthy.
Yes. Hi, Malek.
There is a question here, again from L. Chan. Thank you, L, for all your questions. There's something about basically for investment-linked policies like current times, when all stock bond prices are down, are funds protected? He says, in the example, he says about PRS. PRS mixes a few concepts, a few things there. But I'm just wondering if you had an investment-linked policy and under current market environment, when you see the investment instruments that bought under that investment-linked policy are not doing well, should you be worried? I guess this is a question from Al.
Of course, when you invest into investment-linked policy, the funds, let's say it's an equity funds or a bond fund or fixed income fund or whatnot, when the whole market is now for that asset class, if its performance has dropped, your investment-linked fund will also drop in tandem. You should be worried if other things is dropping and your investment-linked fund is not dropping but going up. It means something is different already. So to answer that question straight up, it will not be protected because there is no principal protection or guarantee features. It will move in tandem with the market movement as well. I guess this has answered the question.
Another question from, and this I'm retracing back, I'm going through all the IP questions. This one from Colin. And any advice for protection plans for the elderly, as most health insurance would no longer cover upon reaching 65 years old, or otherwise but really prohibitively expensive. This is from Colin Isidore. Fateen, would you like to attempt that one? Basically about someone who's already 65 years old, trying to get, health insurance is tough, and what would their approach be?
Yeah, for health insurance, it will be expensive when you reach a certain age, especially like 60 and above. So if you can get, it will easily take up like 4 digits every month. So you have to weigh the pros and cons, and then how much is the coverage that you need, and then because of some older age parents in this case, so there might be some history or health condition as well. So this play a part on the cost of the insurance. So this is also happened to my father. So the one like previously he was employed under private scheme. So never think about like I need to pay for health hospitalization policy. So previously it's all covered under company, under employment. So then to take other policy out there at his age after retirement, so it's really expensive. So so he resorted to government medical scheme other than the private one. Yeah.
Is there anything, say you're in your 40s now, is there anything that you can do now to make sure that when you're 65, you can still afford, say, private hospital, right? Is there anything that you can do now, or there's really not much you can do? What would you recommend in their 40s now to plan for the fact that their premiums might go up when will go up when they're 65?
Yeah. So the person can go seek for like investment link plan. So because of so even though 40 it's a bit too late, but then it's still okay. You can still pay out for the premium for a couple of years so that you can have some cash value inside your cash account, so that it will so you can be covered prior to your retirement, and also after your retirement. So there's still the investment link plan still can sustain you for a few years after you retire. So yeah, so if you haven't started, do it now. I mean, like, there's no better time than doing it now. Don't delay, because this is important, especially on hospitalization and life coverage when you have for life, if you have dependents. Yeah.
Okay, over to you, Roshan.
Yeah. Yes, Kevin.
I want to add on that this is something like in a conflicting situation between whether should we buy term or should we buy an investment link policy. While term is good, it reduces the premium outlay you have to pay for now until the end of the day. For certain product, for example, hospitalization medical card, it's something that we really need it, and we need, the more we get older, we need it ever more. So, however, if you are having a term type, that means you are paying every year, it will get expensive and very much expensive. And we have come across with a lot of clients that they are trying to keep up with paying for the premium for their aged parent. But there will be a day that they will realize that it no longer makes sense for them to continue. So while this is definitely a risk that every one of us will have to face later in our life, for medical insurance, I would suggest that you consider to use investment link policy to do that kind of planning. Unless you are very disciplined, you can buy the standalone medical card and you invest the rest of the money that you save. And you make sure the money will be there when you are old enough to help you to pay for the very high medical insurance premium later. And if you were to go for planning through investment link, you can also choose a medical insurance with deductible, so that you can choose a high deductible when you are still young and have company to provide for you. And then while you turn retirement age, the insurance product can actually take away the deductible from that high to a lower deductible. So it will help in reducing the cost.
So Kevin, before we move on to whether you should cut your insurance plans or not during this time of a bit of cash flow concerns, let's talk about the groups that are, who does investment link suit versus who does term insurance suit? Can we get a bit into that before we move on?
Oh, sure. I would say it's not so much for who on or what stage, but what are the objective that you need from having the insurance. If you need a pure vanilla coverage on just death alone or total permanent disability, then I would say term life is a very good choice. Okay, but if you need for other things, for example, like critical illness and whatnot, then you may consider using other options, because these costs will be higher, much higher in the later stage of our life, and you still need it no matter what, for example, healthcare. So that will help you in managing the premium responsibility when we are old enough next time.
Okay, so it really depends. It really depends on your situation.
Yes.
So just to everyone who's just joined us, my name is Roshan Kanesan. I'm the producer and presenter of Ringgit and Sense. Joining me today on the BFM webinar, Malek Ali, co-founder of founder of filife, also founder of BFM, who's co-moderating this with me, and the experts on our panel today, Fateen Rosli of Wealth Vantage Advisory and Kevin Neoh of VKA Wealth Planners. And today we're talking about protection plans, but specifically the question we're going to get to now is should you cut your protection plans during a time of a bad time or during a crisis time. And of course, this webinar, and as the past webinars have been, we've done this in conjunction with the Financial Planning Association of Malaysia, who put a lot of work helping us put this roster of guests together. So we've talked about the basics of protection plans, the different products out there. We've gotten a bit into investment linked planning. Let's talk about the question on everyone's mind: should I cut down my protection plans if I don't have enough cash? But before we get there, let's talk about the amount you need when it comes to insurance. How do you calculate this, Fateen? How do we get that number? How do we know how much we need?
Okay, so there's few elements in how for you to calculate what coverage amount that's sufficient for your needs. So firstly, do know that how much is your annual expenses. So say you want to cover for about maybe 5 years a minimum. So the 5 years that you want to provide to your family. So you times by 5 years, say, and then how much is your debt that's not currently covered by insurance, like your car, your credit card, your personal loans, those kind of things. And then how much is your final expenses, your burial, cremation costs, add up with your estate administration, those kind of things. And then your minus off your asset value that you have, existing protection amount that you currently covered if you have, and then you can have like how much you still need for the amount. So also that if you want to add up for your child education, so you have to add up the cost into that. So that one is like for life coverage. So what about like income disability replacement, disability or critical illness? You can just like a simple calculation. How much is your salary, gross salary, annual gross salary, and just times by 3 years or 5 years, like that. So that is just a simplistic calculation.
So there were two methods there, right? Basically, one is looking at the expenses side, and one is the income side, essentially.
Yeah, yeah.
And on the expenses side, very simply, you want to cover your family for 5 years. You calculate how much your expenses are and the other things that could come up. You calculate that and you get coverage for that amount. That's essentially one way of looking at it. The other one is you take your income and you cover the income that would be lost. So these are the two things to keep in mind when we start looking at cutting protection during this time, especially if you're cash strapped. So Kevin, let's get into that right now. During a time like this, during a bad time where some people are facing cash crunches on their side, cash flow issues, what are their options? I mean, we've discussed some of them before. Could we just go through a bit of them now and then talk about the protection plan part?
Sure. Thank you, Roshan. I would say that generally you can categorize people into four categories. The first group will be those who still need the protection, but they also need extra money in their pocket. So what are their options? They can keep the protection by not paying it anymore, but the protection may lapse or terminated. So they are like trapped in the middle. So these are their options. If they are having the old type whole life traditional policy, they can actually not stop paying. It will be converted into an automatic premium loan. What it means that the insurance company is borrowing you money to pay on the premium every month. So of course it will attract interest. Then the second one, if you need extra money, lump sum money in your pocket, you can actually borrow against the cash value of your policy. That means you use your insurance policy as a collateral, then you charge to the insurance company, they will borrow you a lump sum of money out of the surrender value that you have. Then if you have a traditional policy, for example, like savings plan, you may have cash bonus or survival benefit that you did not withdraw in the past. So it's still deposited with the insurance company. You can check on this. If you have and you need more money, you can actually make a withdrawal. So it will put more money into your pocket while still keeping your protection plans with you. And then if you are having investment-linked policy, your option is pretty straightforward. You can make partial withdrawal from your investment-linked fund, but it will affect the policy sustainability well into the future. And the last option for investment-linked policy holder will be, you can consider to reduce the coverage amount so that it may help you to bring down the premium that you are required to service every month. So these are the first group of people. You still need the protection, but for whatever reason, you also need more money in your pocket. All right. So the second group will be, you do not need protection. What you need is cash only. So very straightforward, just cut it because you no longer need the protection anyway. So why bother to keep it, right? So just cut it, and if there is any surrender value, then you should expect it to become into your bank account and eventually available for your disposal. So when you select what kind of protection you don't need, maybe it's best that you look at products such as your savings plan, your education plans, or those endowment that you still have to pay for a long term. This maybe will be the first priority for you to determine to let go. It will be the first priority for you. Then the third group will be people who need the protection, but you know that it's very difficult for you to service the premium moving forward. So you want to keep it, but you cannot keep it. So what can you do is you can take a premium holiday if you are having an investment-linked policy. So the term already suggests to you it's a holiday from paying premium. It only available for investment-linked policy. So for traditional policy, you can convert, you can take up a premium loan so that you no longer have to pay, but it will accumulate as a loan to you. Then if you really have no choice, but you want the protection to still be available, you can consider the last two options. You apply to convert it into a reduced paid up policy. What it means is that the protection amount will reduce, but the policy will continue to cover you until the end of the tenure and do no longer have to pay any more premium. Okay, it happens because they use the remaining cash value to pay up for the policy. That's why it's called paid up policy. The last option is you apply for it to be converted into an extended term insurance. This is on the contrary with a reduced paid up. Reduced paid up, your protection amount will drop. So in an extended term insurance, your protection amount maintained, but the length of coverage will shorten. So it allows us to keep the protection by not having to service anymore, and without have to surrender it at all. Then the fourth group is you need protection and you also don't need cash. You have a lot of cash. So for this group of people, maybe you want to buy more, but bear in mind, protection is only meant for protection. It's not meant for investment. If you have more cash, what you should do is review how you should grow your money to support your lifestyle in the future. So do not throw all your extra cash into investment insurance product also. So these are the four group of people and their respective options.
All right, very, very comprehensive there, Kevin. Could you just quickly give us those four categories again? So you've got, you don't need the money.
Okay. You need the protection. You also need extra money in your pocket. This is the first group. Second group is you don't need the protection and you need cash. So this one, you just surrender it. The third group, you need protection, but it's difficult for you to continue service it month over month. The fourth group is you need protection and you also don't need cash. That means you have a lot of cash.
All right. So to each who from the four different groups, each of them have their options, as I think you've already gone through that quite thoroughly. Fateen, do you have anything to add there before we move on a little bit?
No, I think that is like really detailed enough. Kevin said just that I was like, oh, the fourth one, no need protection and no need cash. So it's like something like, oh, there is such thing.
That means this person is not affected by the pandemic.
Yeah, you're not affected, but have money, don't know where to put.
What a nice problem to have.
Yeah.
So before we move on to some other questions that have come up on Facebook and stuff, could we look into, so one of the options there is obviously the surrender value, cash value. That's part of some of the insurance policies out there. And some people are probably going to be looking at that now, even that group you mentioned that last, right, Kevin, don't need protection, don't need cash. They could be looking at, I mean, whether to surrender the policy and take out that cash. It's not just them, but I guess different groups, all of the four groups, I think, will probably be looking at this. What are some of the key considerations here before you cash out, before you think about cashing out your policy?
Okay, especially true for investment-linked policy. If you make a partial withdrawal or cashing out from the value that you have inside the policy, it will affect your future protection, whether this policy can sustain how long. So you need to consider this. I think there's only one point to consider. Will you still need this insurance policy when you are old? If this policy contains your hospitalization benefit, then this is the last thing that you want to make withdrawal from, because the moment you make withdrawal or the moment you take a premium holiday, it will affect the future cash value that you may have, and which will subsequently affect your ability to keep the benefit when you are old.
Also, can I add? Yeah, can I add on the, if you have a few policies, then you may want to review. Look at each term of the policies, make an analysis on your own. How much are you paying? How much is the coverage? Then from there you will know how much is the actual coverage each of the insurer provided to you, offered to you. So from there you can know which one is important. Obviously the hospitalization is important policy, the life important. So if that's redundant, then you can cut first policy or second policy, those kind of things. So it is very important for you to list out, to know what you have, and then make an analysis of your own protection. As you know, you would need to review your policies that you have every 2 years, every 3 years, or each time there's changes in your life, like a new child or different, you have additional house or additional car, those kind of things. You have to analyze back whatever coverage that you have. Yeah.
Yes, Malek.
Yeah, I think it's very common. I hear this very. I'm not sure whether it's the same your experience, Fateen and Kevin. A lot of people say to me, "Oh yeah, I think I have insurance. My parents bought me something, and I bought something before when my uncle, sort of came and talked to me, but I'm not sure exactly what I have. I think I have this. I think I have that." Is that quite common to you? Is that a very common experience that people kind of like have a hazy idea of what they bought?
Yeah, it's really common. They
It's quite common.
Yeah, they only know how much they're paying every month, but they don't know the coverage. They do not know the product. Yeah, I don't know. I think it's investment linked policy, but I don't know. Let me check. I don't know where's my policy. I need to check. Okay. That's common.
So what's the advice? Yeah, Kevin, go on.
It's common because most consumer, we just bother about how much we want to, we are paying every month, and no one bothers to really pick up the policy and open it up and read the fine print.
Okay.
So that's why eventually you do not really know what you're paying for. So it's very important to do a review. I've seen people who have 3 medical cards, 3 different policy. So I wonder why they are paying for that. So we need to discuss and realign their objective. Then they will see that actually actually only one is required to be kept.
Yeah. But it's not, you must admit, it's not easy work, right? It's not easy work. It's insurance policies are lots of terms and conditions, very detailed. And I remember one of the most useful things that I think when I first met a financial planner is to basically condense everything into one page, and they say, okay, this is how much you're covered for. These are the most important conditions and things like that. So for someone who is like either do not have time or trying to they need help with this, is it good to go to a financial planner to kind of like say, and just give them the documents, or do you need to do some of your homework yourself? What is the better way of, for someone who is a bit hazy about what he or she has?
Okay, so for if a person approach a financial planner, so the first thing is like we will always gather all your documents, so all your policies, all your S&Ps, those kind of things, and then we will ask you about your cash flow, your asset, your liabilities. So from cash flow, you would see that okay, there's the person may be skewed to a lot of paying insurance, those kind of things, because we do some analysis and ratio. So the rule of thumb is like for you to know that whether you're paying more for insurance or not, it's like you need to calculate. It will not be like you cannot have paying more insurance of 50% of your annual salary. So that's the basis. So if like you pay more, so you know that your cash flow is like you'll be like affected in a bit. Yeah, affected a bit, just that you're paying a lot. So I just want to quote one case. So our firm, we received a client who's paying 60,000 for one policy a year. 60,000. There, guess how much is the coverage?
Wow, with 60,000, we say what, 5 million, 10 million?
No, 1 million.
No.
and the person have another 4 policies. Overall, the person paying about 80,000 per year.
Wow.
4 insurance policies only. And then what makes me sad is that the person have like salary about 6,000 a month. So plus there's another second income the person's got from writing a book, so 100,000. So it's like 172,000, but 70,000 pays for insurance.
Wow.
Doesn't make sense. And it's so sad, doesn't make sense. So that's why it's really important for you to review back to know whether there's redundancy on your policies or not. Yeah.
I can put it on record that for a RM1,000,000 policy, I think we can, filife can do it for 130 ringgit a month. No problem. So in fact, that's our, or no, if you look at our website, it's just 1 million straight away. You pay 60,000, you can pay 1/20th of that. Anyway,
yeah.
Wow.
So that's the financial cost that the person have to like bear for a few years. So yeah.
Kevin, what's your example of situations where you think, wow, this is complete overpayment?
I think Fateen has quoted a very good example. Because time is of essence, let me state something. I think many consumers, they do realize that it's very important for them to conduct their insurance policy review. However, they are also trapped in the middle whereby if I ask someone to do a review for me, I'm also afraid that this person will take the opportunity to sell me more product, which actually happens most of the time. If you ask an insurance consultant to do a review for you, I would say majority of them will be, you will end up having more insurance, or you actually terminate your old insurance to buy a new insurance. So consumers are in a state that they do not know who to go to or whether someone will actually be taking their best interest at heart. So if you want to do a review on anything you have, be it insurance, investment, or even your will, you need someone who can be independent and really look at the matters from your perspective and in your shoe, not thinking about, if I do this for you, how can I sell you something else? So that's why a lot of us, we want to do review, but we do not know how to proceed. So in the end, we just wait until I know who to find.
Here's a question from Facebook again. Al, you're very active today. Very good. We talked a little bit about, I think, Kevin, when you're talking about sort of being lent premium, when you are lent some money to pay to service your premiums by the insurance company, what's normally the interest rate used, for this lending?
For the automatic premium loan or the policy loan, interest rate will vary from insurance company to insurance company. Some may be 6%, some 7%, some 8% a year.
It's not the credit card rates, lah. It's the kind of like, it's somewhere, it's 6
it's lower than personal loan because your insurance policy will become the collateral. So that's why it's cheaper than a personal loan. Then, but this is different from the insurance premium moratorium that has been announced during the MCO. That one is a program whereby affected individuals, which means if you are infected with COVID-19 confirmed case or require mandatory quarantine, or you can prove that your income has dropped due to MCO or COVID-19 infection, then you can apply with your respective insurance company to have your policy premium be deferred by 3 months. The word deferment means you still owe them, you still have to pay, but they are just putting a freeze on it for 3 months. At the end of the moratorium period, you still need to make good with the overdue premium.
And how have you seen this between insurance companies? I mean, some are saying, oh, you have to pay, you pay 6 months back at one shot, or you kind of like stage it over a period of time?
The terms and condition is such that they can defer your premium payment for 3 months. Mm-hmm. Then at the end of the program, you have to pay back. So it depends on the product type. If you are having a term insurance and you are paying monthly, then you defer for 3 months. At the end of 3 months, if you do not pay back the past 3 months premium, then you may enter into a grace period. After the grace period, if you still do not pay back, then your policy will lapse. But for investment-linked policy, it may work differently because there is cash value to help you to offset the cost of insurance. So it depends on the type of insurance that you have.
Okay, all right. Here's a question from Stan Lim on Facebook. What is your opinion, Fateen or Kevin, on medical insurance with a 1 million lifetime limit? Is that a good thing or not?
Okay, for us, we always advise for medical insurance or medical hospitalization policy, annual limit minimum is 1 million, not the lifetime limit. So you would need annual limit that will reset each year. So the minimum annual limit is 1 million, not the lifetime limit. Yeah. So there's insurance company out there that offers that high limit per year.
Oh yeah, okay. And why is that? So that 1 million sounds like a lot, but is it really a lot? That 1 million annual limit?
I think it's fair because of you can say about what about organ transplant, this kind of thing. It will be expensive, especially a heart transplant will cost you about 700,000. I think so. Depends on hospital.
Depends on illness.
Yeah, it depends on illnesses because some people might not need that much, but some people do need. But then for me, if your policy state lifetime limit as 1 million, but you need to rethink back, there will be that annual limit also stated there. So if the annual limit 100,000 1 year, if you use 10 years, then it's already lapsed.
Yeah. So I guess your recommendation is, do not go for policies which has a lifetime limit. Of like, unless it's lifetime limit of 1 billion, don't. If your lifetime 1 million is not going to be enough. One operation might set you back, almost finishing up all your lifetime limits. So there's the answer to you, Stan. Great. Over to you, Roshan.
All right. So we are in the last 4 minutes, actually. We are in the last 4 minutes of this week's webinar. And I think I just want to wrap up with a little bit of what are the other important things that people should know when it comes to protection planning. I think, Fateen, can we start with you on this? Just a quick summary of some things that people maybe take for granted or don't put enough importance on.
Okay. So the first thing first, be honest. Make full disclosure on your health condition if you have. So be honest with the person that you are applying your policy with. So that is the first thing, because you don't want anything in future you can't claim or anything like that. So secondly, do note on the terminology, nomination versus wasi for takaful and hibah for takaful policy. This is because nomination or wasi is just the person who going to be an executor. And if like for Muslim, you will need to distribute the amount, the sum assured, accordingly to Faraid law, versus the hibah. Hibah is a gift that you can put in the beneficiary name. So that is the two things I would like for the consumers out there to really take this as important detail that they would need to know about their own policies. Yeah. So other than that, maybe Kevin, you want to add on?
Maybe I just add on something that has been practiced for a very long time, but it's something that consumer needs to rethink about the priority. Insurance is something that you need to be sold, but nobody wakes up and want to buy. And as a matter of consequences to this phenomenon, we end up buying insurance not because we know we need it, but because friends and family is calling you, hey, support me lah. So at the end of the day, you buy insurance because you want to support your friends and your family member. I think you need to think about this very seriously. You should buy insurance because you need insurance and you want it to be there to support your family when there is a financial hardship that's happening because of your untimely death or critical illness. So many a time we see people end up having a lot of insurance premium under their cash flow. It's because they buy to support someone to win an overseas award and whatnot. So at the end of the day, who is suffering is the person who has a kind heart to support another person. So it's very, I do not like to see this kind of phenomenon. And I think it's important for us to acknowledge that you should buy insurance to the amount that you need and select the product solution that actually meet your need. Then for the money that you save, you have to think about what are the other things you want to do with your life. For example, retire young, send your children to study overseas. Then you have to find somewhere and some instrument to invest this money. This money has a better mission than to support someone else. So this is the message I want to get across.
A very comprehensive message there, Kevin. I think we can always count on your messages to hit the mark in terms of comprehensiveness. And on that note, with 30 seconds to spare in this hour, I'd like to thank all of you for joining me today. Thank you for your insights. Thank you, Malek, for helping me out with this. And to everyone on Facebook who's tuned in, thank you so much for your time on a Tuesday afternoon at 12:30, where some of us are going back to work. We really appreciate it. And next Tuesday, 12:30 p.m., we'll be back here online, and we'll be talking about the MCO has tanked in my investment. So how? And we will be talking to Danny Wong from Erica Capital and Lim Hui Hui from Core Plus Advisory to get some advice on this and how do you manage the situation. On that note, I'm Roshan, Kanesan, producer and presenter for Ringgit and Sense, and this has been a BFM webinar. We've got the feedback survey in the comments below. Please let us know what you think of this. Everyone have a good day and a good week ahead.